Ticker symbol WST has returned over 12% in the past year, and boy has it been a wild ride. It got to all-time highs in September, to then get to the yearly lows in November, get back again to all-time highs in February 2024, dip down and then come back up for now April. But I believe that today we'll be looking at a highly profitable company in what you would call a boring industry. And this is a great opportunity stock as it has solid fundamentals, high efficiency ratios, and it is in a sector that has low innovation and low competition. So today we'll be looking at West Pharma Services. You can say that it's a medical equipment company. So in their annual report, they see that they're a manufacturer of high quality integrated containment and delivery systems for injectable drugs and healthcare products. This sounds very complicated, but basically they provide a variety of packaging, containment solutions, transfer systems, and drug delivery systems, as well as contract manufacturing, analytical lab services, and integrated solutions. So basically, whenever you're going to get a vaccine, that vaccine, you can see that they get a liquid as it's shown over here in the picture. So they basically provide and create those type of bottles for the containment and transfer of these liquids. They divide their products into two different segments. The first one being proprietary products, which consists of the solutions and the products that we just spoke about. And they basically manufacture these themselves in facilities they have in North America, South America, Europe, and Asia. And I believe they also have some partnerships to manufacture this in Japan and in Mexico. So then the second one is the contract manufactured products. And this is basically the design, manufacture, and assembly of complex devices for pharmaceutical, diagnostic, and medical device customers. So these customers will send them a list of complex devices or a requirement of complex devices that they require to operate, and West Pharma will basically design and manufacture these products for them. But this gets a lot more interesting when we break the company down into numbers, as they have a very high return on capital employed of 18%, which is best in class. They have an interest coverage ratio of 77 times, meaning that they won't have to worry about debt in any time soon. They have a very solid cash conversion of 111%, and this is very important as it represents how good the company is at converting their net income into free cash flow. And here they basically say that for every dollar of net income, they can provide $1.11 in free cash flow. Then they have a very solid profit margin of 38% and a very high operating margin of 24%. Now this company is extremely consistent, and as you can see, the revenue, gross profit, and net income have not moved much from 4 years ago. They have been having more or less the same margins, more or less the same revenues, and this company is pretty stable. And the fact is that this company does not like leverage. They do have a little bit to try and grow at a faster rate and leverage their operations. However, you can see that their current ratio right now is trading at around 3 times, and their debt to equity is trading at around 0.1, meaning that they have almost no liability risk. And in terms of efficiency ratios, these are generally in the very good side, but they do trade up and down a lot depending on the net income that the company gets on that quarter. However, right now the return on invested capital is comfortably sitting at 28%, which is extremely solid and top of the class against its peers. But when moving into the fundamental analysis, we can get that this company, starting up with the low liability risk, as we saw in the first slide, they have a 77 interest coverage ratio, then moving on to having a very solid balance sheet, which basically consists of them being able to pay all their short-term liabilities with their current assets. Then they're very good at providing consistent cash flows, and of course this company pays a dividend and conducts share buyback programs, which is very, very important. The dividend is not huge, but they're starting off with a very consistent small dividend, and this is good because the combination of these two aspects basically means that they are returning a lot of their generated free cash flow back to the investor. Now this company does have pricing power as they offer a very unique solution, and whenever companies come to them and say, hey, I want you to manufacture this, you basically do have a kind of a pricing power, because generally what is done in this type of industries is, okay, I will do this, this is how much it will cost me, and then I will add a markup of whatever percentage I will say over the cost that it will cost me to produce. So basically you're ensuring that you will have a consistent margin no matter what the costs of producing those products are. They do have organic revenue growth, however, they are not able to convert this revenue growth into organic free cash flow growth, or at least they were for the past 5 years, but not for 2023, and this is a bit worrying. Now, finally, the most important point in this slide, the existing moat or competitive advantage. They clearly have a huge competitive advantage as they're one of the best companies in terms of manufacturing medical devices. As we can see, a lot of customers come from overseas just to hire them to design and manufacture products that they will be using later in their operations. And by having facilities all around the world and in the majority of the continents, they're able to treat all the important clients and get to them as fast as possible in the most cost-efficient way. Additionally, the main products that they actually produce, their proprietary products as they call them, the packaging and delivery systems for medicine liquid, is something that is, as Peter Lynch would call, a boring industry, meaning something that has been working the same way for a very long time, where there is very low innovation, which in part is good since if it's a very profitable industry like this one, the companies can be off as having a competitive advantage, not allowing other companies to enter, but keeping all the profits for themselves. They do right now have a small dividend yield of 0.2%. However, we can see that their strategy over here is to increase their amount paid and their dividends per share slowly every single quarter, and they have been doing so except from November 2020 to April 2021. Now, when conducting a long-term analysis and growth potential ideas, the first one for geographical expansion, I believe that they are already perfect in this since they have many manufacturing facilities all around the world. And the second one of creating new offerings and developing new offers would be ideal for the company, as I believe they have been doing the same thing for a long time. And as we can see, their growth is kind of cyclical and unpredictable. So by creating new solutions that you can upsell your clients and get a little bit more of recurring revenue, this could allow them to grow even further. However, in terms of valuation, right now they're sitting at a very expensive valuation, I would say. I don't believe that it's reasonable based on their growth. Right now, they have a free cash flow yield of 1.44%, which when compared to the long-term inflation rate of 3%, actually deems this company as being expensive and not at an attractive valuation right now. Now, when looking at the risk and possible challenges, the main risk in C is the competitors and the worsening of the competitive landscape, where even though this company has a very big competitive advantage and it's a very boring industry, the second industry that they're in, which is the designing and manufacturing products for other type of industries, is not a boring industry as Peter Lynch would call it. I believe that that is an industry where there is a lot of money. You have to be extremely innovative and be sure that you're offering the lowest cost basis for your customers, as well as providing and meeting quality standards that are set by them. So this is something extremely difficult to achieve consistently, and you have to meet the needs of such a wide variety of customers that of course they are going to be another type of competitors, just showing up with more innovative solutions, better relationship with clients, understanding the needs of the different segments that will try to steal market share from you. Now, in terms of regulation, of course, there's always the risk in pharma of possible upcoming regulation changes, and that is the thing that will drive revenues the most in that type of industry. However, I don't see any possible upcoming regulation changes, and I don't see them not meeting their performance objectives since they have been meeting them for a very long time. Now, finally, in terms of market, I don't believe that this market will be heavily affected by an economic downturn since people will still need to get their vaccines and get their medicine. Now, before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this is a company with a moat which provides consistent and predictable cash flows, which has a high return on capital employed, especially comparing it with an industry, which means that it could create value for the investor. I think that this is a good company and may be a good investment, but I don't like its unpredictable growth, so I will stay away from it for the time being. Thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.